Right then, in this video, I'm going to talk about grid trading and averaging. Now, grid trading and averaging are actually very similar in the way that they work, and they're both essentially the same thing. They're just done differently. So I'm just going to give you a couple of examples now, and then you'll see sort of how it works. I'll also, just for the sake of it, I will actually compare this to a typical sort of stop loss trade. Anyway, let's imagine that for whatever reason, we expect this level to break and we think price is going to drop. Okay, now you might be saying, oh Ben, let's look at this, it's a break and retest, it's going to go up. Yeah, fine, okay, this is not a valid trade, I'm just doing this as an example. So for whatever reason, let's say that we're going to sell from here. We don't think this is going to hold and we think price is going to push back down. So this is our trade idea, we put a sell on. Now let me just stick a short position on. Here is the previous high, so let's do what all traders do. You go just a little bit, whatever your favorite distance is above the previous swing, and we set our TP, let's say at this level down here. So that is your trade. That's what you're expecting. So this is our stop loss, and at the same time we're going to do averaging. Okay, I'll show you averaging first. So I'm going to stick a sell trade on. Let me just move this over to the side. In fact, let me slide this over here. I won't move it so we can just sort of see what happens. And with averaging then, if the trade goes against us, we're just going to add more trades to it. But you don't add them like a madman. You don't add them like a lunatic and just pile in, which is what a lot of retail traders do, and that's why they lose money doing it. You do it in a very set, specific, controlled way, okay? Now, averaging is widely used by banks, investment funds, pension funds. Very successful investors, people like Warren Buffett, use averaging extensively, okay? Warren Buffett loves averaging. You can read a lot of articles he's written on it. It works really, really well if you control the risk and you do it sensibly. It can absolutely wipe your account out if you're greedy and if you're just risking too much money, essentially. So let's have a quick look. Let's see what happens on the next candle. Push down a little bit sideways, still sideways, nothing really happening. Something's going to happen eventually. And okay, price has sort of spiked up. Now it hasn't got to the previous high, so I'm not going to do anything. Let's just have a look. I think we're right on the stop loss. We're almost stopped out by the look of it. However, price has reached this level. Okay, so this, let's say we're going to average, we're going to add another sell trade here. Now what I want you to watch is what happens to this red line. So right now, in order for us to make a profit, price has to be below. So price has to come back down from where we are and get below this red line for us to make a profit, because we have one position open. That is about to change. When I add a second sell position now, this red line is about to jump up. In fact, let me draw it on. We have one trade here. We're about to add another trade here. And I reckon that's going to be the average price, somewhere around that middle blue line. So I'm just going to press sell. And you've seen that jump up, and it's pretty much in the middle. So what this means now is I don't need price to get back down here to my original trade. I only need it to get below this red line. And when it gets to this red line, I'm at break even. I could close both trades and just exit. Okay, so I'm now in a much better position to make money. The dynamics of the trade are completely different. So let's just get rid of that for a sec. And then let's see what happens next. So by the look of it, I would say this has it just been stopped out? Yeah, okay, so our stop loss trader, he's just been stopped out now. That's it, he's out the race. Let's just delete that. And we're going to see what happens next. And price shoots up again. Got a lot of momentum. What you want to see is some sort of indecision before you consider adding again. We could zoom over to the left and see if there's any resistance or anything like that. Still quite a lot of momentum here. And there we go. We get a little candle, little bearish candle. It stopped breaking highs. Let's put on another sell trade. Now, before I press sell, what do you think is going to happen to this red line? When I add another trade, it's going to drag this red line higher. And again, that means that we don't need price to come all the way down here. If this red line moves up, we might only need to get out here now, okay? So it's actually becoming easier for us to get out in a profit, even though we were wrong. Even though we thought the market was going down and it's gone up significantly, we would still be in a position, a really good position, to get out at a profit. So I'm going to press sell again, and I want you to watch the red line when I press it. And you see it jumped up again. It's now actually sitting just above this high, which is a very likely place for the market to retrace to. Think about how a market moves, okay? When it makes highs and lows, where's this going to pull back to? It's going to pull back to the previous high, like that, before it probably continues. That's exactly what we're seeing here, look. It's the exact same pattern. So look how well this strategy works with the way that markets move. This is now very likely to drop down to here, which allows us to get out at break even if the market continues higher. So this strategy actually fits the way that the market moves. Anyway, I'll stop talking and I'll actually press this little button. Let's see what happens. And I reckon the market is probably going to drop at least to that red line, because that's just market structure. It's how markets move. Now, there we are. We've popped below it. And at this point, we're in break even or a small profit. Now, you have loads of options now. You can exit the trade at this sort of, let's call it break even. It's only just below the line. Or you can hold for your initial entry. Or if you still believe price is actually heading down here, you can hold all the way for that point. But what I'm trying to point out is that it actually gives you way more options when you don't have a stop loss. As long as you know how far this can go and you've set your risk out appropriately and you've averaged sensibly, then this is going to be the result most of the time, is that now you're in a nice profit. It's made it back to your entry. All 3 trades are in profit. And you close the trade, job done. Now, look at how different that was to the stop loss, where the trader got stopped out and then price came back after he was stopped out. Very, very annoying situation. So what's the difference between a grid and averaging then? Well, a grid is just averaging with sort of predefined levels, essentially. So let me just go back to our trade, and what we'll do is we'll just use a modified fib tool, and I'm just going to set out like a random, I'm not even going to measure it. So this is our grid. I want you to ignore that red line. Let's imagine that each time, where's my arrow? Each time price reaches one of these levels, we're going to add another cell. Okay, so even if something like this happens, which pretty much is what happens, then what that's going to do is every time we reach a level, we're going to put on another cell. So all that's happening now is we're averaging, but we're doing it in a grid sort of formation, a grid layout. These distances are predetermined. We're not doing it based on sort of candles or levels, or sorry, support and resistance levels. This could be 10 pips, it could be 50 pips, 100 pips, and it doesn't even have to remain constant, okay? So, for example, you could say, well, my first 5 trades, whoops, I do that all the time. Let me just get rid of a few of these. What you could say is you can change the grid over time. You could have a very, very small grid. Now, this might be sort of 5 pips, and then after that, you could shift to a larger grid. So you have your trades very close together at the start. Let's look at this again. If the market pops up, try it again. If the market pops up, okay, something like this, you would have triggered in all of these trades here. But then if it continues, you're now triggering in much less trades because they're spread out, and this helps you to sort of survive the move. So grids can be incredibly flexible, even though they are rigid in their sort of distance, their predetermined distance. There's still a lot that you can do with them. You can still be very, very flexible. Anyway, let me just stretch this out and make a random grid, and we'll just sort of finish this example. Now, annoyingly, TradingView does not let you do pending orders when you're in replay mode. So what I'm going to do is, if the price reaches a level, we're just going to say that we've put the trade on, okay? So right now, let's just start here. We are in trade number 1, and let's see what happens. Price goes down a little bit. And obviously we know it's going to pop up. Right, so here we've just hit the first grid. So at this point here, okay, we've just put on our next trade. Let's go up again, see how many more we trigger. So we've just triggered in another one here. Will we trigger one more? Yes, we have. So we've now triggered in trade 3. So you can see the difference now with a grid compared to averaging. With averaging, it was based on whatever you want it to be based on, intuition, on candle patterns, on support and resistance. Whereas with a grid, it's just predetermined, okay? You've already sort of set out the grid and where you're going to add more trades. And then obviously, as we know, price eventually comes all the way back, and that's it, you close the trade. So that's the difference between grid trading and averaging. They're both very, very similar, and they both have their own sort of pros and cons. But this is what I will use extensively, what I do use extensively in all of my trading, including this strategy, for the simple reason that it fits the way that the market moves. If you think about all of the lessons that we've done in this section so far, mean reversion, the round numbers, the impact of news events, the news retracements, price not being precise, all of this stuff is essentially fits averaging and grid trading strategies incredibly well. because it's very forgiving. You don't have to be right. If you look at the scenario in front of you right now, we thought on our very first trade the market was going down. We were absolutely, completely, utterly wrong. The market went up, and the result was that this trade made a profit. This trade, I'm going to scream, honestly, my arrows today. This trade made a profit. This trade made a profit. And our initial trade was probably break even. In fact, it's slightly below, so that made a profit as well. So we were absolutely, totally, completely wrong, and we ended up with 4 winning trades. The stop loss trader who had his stop set at the high got stopped out. So, you know, this may even, and this is the really sort of sad part of trading, is that this might actually continue all the way down to his TP, but it doesn't matter. His stop loss was hit first and he lost and he's already out. And that's just because stop losses do not fit the way the market moves. Averaging and grids fit the way the market moves really, really well. You just have to control the risk and be sensible. So that's what we're going to look at in another section. Once I've shown you the strategy, I will do a detailed video on risk management, money management, and making sure that you understand that you need to be able to survive the moves that happen, and obviously what to do if it's uncomfortable, if you think this is going to go too far, how to take losses, how to do partial closes, all that kind of stuff is going to be covered. So I'm going to teach you how to do this properly. So I hope you've enjoyed this section. I hope you now understand all of the sort of theory that's going to go into creating the strategy. And in the next section, I'm going to show you how to get yourself set up ready to trade it.